Welcome everyone, and today we will do uh, the third part of our mm, third part of our class or discussion, which is psychology and the market trends. How the how the psychology works during the market trends, and how to identify the trends. So in the previous lectures, very first one we covered what is the markets, what are the types of markets. In the second one we covered the fundamental analysis, and which was actually 2A, and in 2B we covered the technical and the mathematical analysis. This is the third video where we are going to cover the psychology and the market trends. So let's begin. So very first thing is there is a difference in the economy and the markets. Equity markets are part of economy, but they are not the economy exactly. Equity markets are equal to 4% or 5% of the total economy. What I mean here is there if you check on National Stock Exchange, it has about 4,000 companies listed. Bombay Stock Exchange has about 5,000 companies listed. So it does not mean that there are only 4 or 5,000 companies in India. There are actually more and more companies in India, and the number is enormous. Our number is even out of the count. So if we will compare, there are lots and lots of private businesses, family businesses, sole proprietaries or partnerships which are doing the economic activities, but they are not listed, and that's why we do not see the changes in their business cycle. So what we are trying to understand through equity markets is we are trying to check that from if the 4% pie of this whole cake, if the whole economy is a cake and the equity market is just a pie which represents 4%, we are trying to gauge that the rest 96% will be better. Okay, so that is the whole logic. If the economy is in bad shape, then automatically we see the effect happening on the equity markets. If the economy is good, then we see the rising prices in the stock market. Then next is how do we recognize all this? We actually recognize this mainly by viewing the charts, by studying the charts, which is the part of technical analysis. You can also take help of some specialized services wherein you can find out the fundamental analysis of every industry trend. There are certain companies who provide the industry financials and the financial performance of the industry itself and they charge for certain fees. So you can take that subscription, which is one way to find out how the economy is doing. So there you can get a full access, and there you can get a full idea about the almost all the listed businesses. The other way is we read through the charts. Okay, so the types of charts, as in the simplest chart pattern is the lines. Okay, the lines pattern, it only considers the daily closing prices. So it is a point A to point B to point C to point D, or for example the closing price of 23rd of August, then the closing price of 24th August, then 25th, 26th, 27th. The another one is the bars, hollows and candles, wherein you actually see a full box. So you see the opening price, the closing price, the high and the low. And the bars means they do not form a box, it is just a single line. The hollow candles are the candles which are without color, and the candles is just the color candles, red or green. Okay, then there is another pattern called Heikin-Ashi, which is a Japanese pattern. So here it has here they identify what is the outcome of the longer tails, like long highs. The highs are far above than the body, or the lows are far below than the body. And then the Renko. In Renko, actually, they do not consider the time. They do not consider the dates. They actually consider only from point A to point B, and then just try to squeeze through in the whole process. So let me just show you an example. Okay. Okay. So I will show you a quick example here. So this is the the weekly chart of Nifty. You can see here, and I have chosen the line pattern. So you can see only the daily closings and connecting from one point to the other, from one week closing to the next week closing. Okay, which was what I was saying. Then this is the bars. So you can, so if I zoom out and I will just show you one type. So this is a bar, okay, where this is the opening, because this is a green bar. So this is the opening. This this is the opening. This is the closing. This is the high, and this is the low. But what happens is, unless you do not expand the view, you cannot easily make out. You cannot easily see the bars in detail. Then the next was hollow candles. Now you can quickly see that the bars are converted into the candles. Simply I will show it to you again. So just focus on this candle. Okay, this is the simplest way. Now just see that the market opened here, the market closed here. This is the smallest high, and this is the low it made over the day. Now just keep a track on 26 July 2021 weekly candle. So when I convert it into the hollow candle, you can see this is the body of the candle. So the green day means when the market was positive. Okay, it is a green hollow candle, so it is not filled, or it is filled, and it depends. I'm not very keen or about the hollow candles. So hollow candles and candles are pretty much same. Now you can see the same candles were actually filled in red and green. That is all. So now you can see in here clearly. So when you make into the candles form, and even if you zoom out, you can easily see through it that it looks like a line going all around. When you zoom in detail, you can easily see that, say, for this particular candle of 2nd August 2021, here the week started at 15,874, and here the week ended. Let me just, yeah. So here the week ended at 16,236. You can see on the top. Okay. The high it made was 16,000. Its high is 16,349, and the low is 15,834. Okay. Then I will just show you an example of Heikin Ashi. So in Heikin Ashi, you can see that there are no, sometimes there are no tails on both the sides, sometimes there are. I am not very comfortable, I am not very much sure about Heikin Ashi, so I will not go in details of Heikin Ashi. Now when I change this to Renko chart, actually you can see that, okay, let me just show you this. So you can see that from point A, let us say from 19th April 2021 weekly candle all the way to here, which is 9th of August 2021. So you can see that actually on the daily, on the weekly basis, the prices went up, down, etc., etc. Now when I change this into the Renko, the 19th April, this is the 17th April candle, and now this is the 9th August candle. You can see it is just the straight boxes. The straight boxes arranged on top of each other. So what I have found out from Renko is generally if the downtrend in the Renko, if it is 2 or 3 boxes, you can see here, then the downtrend continues. Unless there are 3 or 4 boxes in one direction, you cannot confirm the trend. And it is very easy to read in the Renko chart. There is just up and down, very simple way. There is nothing much in here. So these are the types of charts you can see. You can find more information on the internet depending upon your choice and depending upon your interest. Majority people follow the candles. The candles are very simple and easy to understand. So now looking at the charts, the next question that comes to our mind is, we often hear, which is a bull market and a bear market. So what is a bull market? So in terms of that series which everyone might have seen, bull ऊपर उछलता है और bear नीचे मारता है. There was some dialogue over that. So what is the bull market and bear market? Basically, bull market and bear market is the trend. So if the prices are continuously going up, it is a bull market. If the prices are stagnant or if they are continuously going down, then it is a bear market. So that is how it is recognized. The other way to recognize the bull or bear market is as follows. One way is you can use the Dow theory or the Elliott wave principle. So I will explain you the Dow theory in simple terms as possible. So the averages discount everything. Okay, the averages here means the prices discount everything. So all the information in the market, all the good or bad or ugly information in the market is converted into price. That is very simple. Number two, market has 3 movements: primary, secondary and minor. So primary means the market movement on a monthly basis. Then I'm just giving an example. If we consider the primary trend is on the monthly basis, then secondary trend may become the weekly and minor trend may become the daily price changes. Then lines indicate the movement, accumulation, public participation and distribution. So lines means the prices. The prices indicate where people have started buying and stocking lots of shares, then where the retail people have joined them, and where everybody started selling. I will in the next few slides, I will come up with the chart and I will try to explain to the best of my knowledge how this thing happens and how you can identify, or how we can briefly identify these things. And then the price volume relationship. So the another rule in Dow theory is, if you are just continuously looking only at the price, and if you come up with the first 3 parts, then you have to support your logic of primary or secondary trends, accumulation or distribution phases with volume. If there is no volume supporting to your theory, then you will have to wait till the volume shows up to support your theory. That it does not mean you are wrong or right. You just have to wait till the volume supports your theory. And the price action determines the trend. So how the price and volume plays together, and how you can determine the trend, and whether the trend is intact or whether the trend is broken, that is one way. And then the averages must confirm. The last one says that here the averages means all the indices, they must show a similar behavior. If the Nifty 50 is showing an upward trend, then we are assuming that all the indices are showing an upward trend. But in reality, we have to confirm whether they really are showing the upward trend, or some indices are not are in the flat, and some are going down, some are going up. So you can make out that which indexes are actually supporting the Nifty. You may often hear in the news commentaries and all that today, for example, say today the IT index has rallied, but the autos and the metals are not performing, or today the bank Nifty has gone very high, but the IT or the FMCG did not support, etc., etc. So this is what the logic behind most of this is the Dow theory. Okay, so let us see about the first one, the averages, discount everything. So this is the chart of Nifty. Okay, you can see here on a weekly basis. Moreover, you can see that I have plotted the volume below on this side. Okay, the chart is all the way from 2006 to 2021. Okay, till this week. Then I have plotted 3 moving averages, a 9-day moving average. You can see a line which is going very closely to the candles. Then a 30-day moving average, which is this line, which is going little bit away from the moving candles, and then a 100-day line, which is this strong blue line, which is far away than the candles. Okay, so let us see the first principle: averages discount everything. So the price is discounting everything. So on a 9-day basis moving average, you can see all the reflections. So 9-day means there are only 5 days, 5 trading sessions in a week. So 9-day means almost 2 weeks. You can just neglect 1 day. So but 2 weeks trading. So it is very close. And yeah. So this is how the price is discounting. And then the market has 3 phases. So let us see here. So this is the accumulation phase. Okay, I'm just trying to guess. I'm not exactly right in applying this principle. I'm just trying to give you an example how you can then expand your thoughts and how you can search more and understand more. So let us say that the principle we were looking at is market has 3 movements: primary, secondary, and minor. So this is the yeah. So this is the weekly chart. Let me do one thing. Let me just show it to you on a actual chart. That is more easy. Okay. So let's go to the simple candles. Yeah. So we were talking about that market has 3 phases: accumulation, public participation, and distribution. So one example is if you will see this big part, this was mainly accumulation. The public participation here was almost close to nil. Okay, then let me use this. This is mainly broadly the accumulation phase. Okay, now the public participation actually started from here, I would say, because the prices were continuously rising. So you can see this straight trend going up. So this is a public participation. Now if I zoom out, let me remove this. Yeah. Now if you will see in the broader spectrum, okay, so here mainly. So you can see that this is mainly a distribution phase. Why? Because the markets in here because you can see that the markets here were in a line. They were they were stuck in the line. Okay, yeah, if you will see in this time frame, actually the markets were not crossing this border, neither they were going down. They have touched the bottom once, then they rose, and then they came down, and then they rose. So this is mainly the distribution phase. Another way I can show it to you on the presentation. Oh no, what is going on? Yes, another way on the presentation is on the presentation is this part where you can see that here I told you that the markets are not moving much. Mhm. So I am trying to support my theory here with the volume. You can see that you can see more of the red candles, more of selling, and the volume is increasing. Then the volume came down and then it peaked. It peaked in this part particularly. So this is the distribution phase. Okay. Then let me just example again here about the accumulation. Okay. No mind. Then price volume relationship provide the background, which is what I said. So you can check, you can see here the market was falling and the volume is the highest. So I have to support my theory. Okay, that actually I think that the markets are going to fall, but if I cannot see the volume supporting the theory, then I have to wait. I have to wait to reconfirm whether my theory is right or wrong. Then price action determines the trend, so which we have already spoken. So on the three particular moving averages, my long-term trend of 100 days is intact. Hardly the market has traced below the 100-day up to here, but during the 2020 it went below the 100-day moving average very for a long time, and then it came back. So when it came back, the public participation increased and the markets just rallied all the way from the 100-day moving average. And now the averages must confirm, so I will just jump to this last part, wherein you can see that you can see this particular time action of 2020, or let us say that you can see this chart from 2018 to 2020. The markets were fixed into Nifty was fixed into a certain range. Now this is the chart of Nifty Auto weekly. Now just see this chart from 2018 to 2020. So actually the Nifty Auto was continuously going down. So Nifty Auto was losing its shine within the Nifty index itself. Now let us see the next one. Next is the Nifty IT. So I'm sorry, actually this cursor does not move, so I cannot make out where is the 2018, but I'm guessing it is somewhere here. So all the way from 2018 to 2020, if you will see the Nifty IT has been increasing. So the Nifty 50 itself was not dropping in between 18 to 20. The primary, what we have seen is Nifty Auto was going down during 2018 to 2020. Nifty IT has been stable or has shown little bit rising. Nifty FMCG is also pretty much from here. It has also shown a stable to a stable trend. Okay, so Nifty Auto down, Nifty IT stable, Nifty FMCG is stable. Okay, so the effectiveness. So when in 2020, when the markets crashed, it was the Nifty Auto which fell the biggest one. Okay? It showed the biggest correction as compared to the Nifty. So it was dragging the Nifty. Okay, so what I'm trying to say is, I'm trying to use the principle of Dow theory and I'm trying to see how does it matches with the reality. So whenever I see any big change, whenever I'm expecting any big change in the Nifty or a Bank Nifty or a certain Nifty per se, as an index, I have to support my theory using checking for all other indexes and checking whether they are showing a pretty much same behavior. If I find that say Nifty IT and FMCG are looking stable, Nifty Auto is going down, for example, the Nifty Metal is going down, Nifty Oil and Gas is going down, Bank Nifty is going up, then I can make a judgment that okay, there are three indexes which are still pulling the Nifty up, which are still holding it tight, and rest all indexes are going down. Okay, so that is the logic we are trying to establish here. Another way of doing this is the Elliott wave. So this is a Nifty weekly, okay, and I'm trying to plot. You can find about information about the Elliott wave on the internet. So Elliott wave says that there is a its principle is there is a super trend which remains for months or years. Then there is a that is called a super cycle. Then there is a cycle, bull cycle, which remains for months. Then there is a intermediate bull cycle which remains for weeks. Then there is a minor bull cycle which remains for days, and vice versa. Even it is applicable for the bear. So I have tried to just give you an idea and heads up here how you can plot or use the Elliott wave to determine what is the trend, whether the markets are in bull phase or bear phase. Okay. So what I've tried to do here is I have just picked a point of 2012. This is just an example. This is not a precise logic I am applying here. I'm just giving you an example. So here in 2012, I considered that okay, the trend started. So this is the first peak I see because here the index is about 5,000 and up to this first peak it is about 9,000. So from 9,000 the index corrected up to 7,000. So the correction is 2,000 points. But then the next rally I see, the next rally it went up to 12,000. So it went from 9,000 top to 12,000 and then 7,000 bottom to 12,000. Then it corrected to 8,000, 7,500 and right now it is going up to 16,000. So I'm saying here that the long-term bull cycle is intact. Even if the markets corrected 30-35%, the long-term bull cycle is intact. Now I'm finding the shorter trends. By the way, the long-term bull cycle is the blue line and the short trends is the orange. So all the way from point 2 to point 3, I am just plotting a small intermediate trend, which is from this point to starting from point 2. The first peak I see is 9,000, retracing it to 7,000. Then the second peak I see is 11,000, retracing it to 10,000, and then all the way to 12,000. And then actually the markets did not drop below 11,000 any point here until the April or May 2020 appear. Okay, and then after there was a fierce correction all the way down. Similarly, I have tried to find another cycle during the markets rallied from 7,500 to 16,000. So it started somewhere here in June or July all the way. This is the point A, then point B. So it rallied up to 12,000, corrected to 10,500, then straight rally up to 15,000, then a small correction of 14,000, 13,500. Then next correction is up to here, point E, which is above 15,000. Okay, I will try to show the same on this chart as well. Okay, so this is one of my small attempt. So here it starts from 2009 at the price of 2,800 all the way up to 6,000, then 6,000 corrected to 5,800, then all the way to 12,000, then all the way to 12,000, 12,000 corrected to 8,000, 8,000 straight going up to 16,000. So this is one way you can plot the Elliott wave, and you can make out what is the long-term bull market, what is the bear market, and how does it look like. You can take a help of fundamental analysis, but then for that you need to pay for that service to certain companies who do the whole analysis. If you want to do the fundamental analysis on your own, or if you can read through magazines and news and etc. and find out on your own. The other two ways are using the Dow theory and the Elliott wave. So I have tried to explain it to the best of my knowledge. I'm not very professional with these methods. I just want to give you an idea of the psychology, that how does it work. Mainly what we are looking at is we are looking at the accumulation, public participation, and the distribution phase. And we need to know the accumulation phase and the distribution phase mainly. So you know where to enter and you know where to exit. Okay, so I think I will end this here. Let me know how do you find this video, and if you want to know more about this, then I will take some time and I will study it hard, harder than now, and I will come back to you on that. Till that time, if you want to hire my services, we will charge you some fees, and we can do the fundamental technical analysis for you, and we can do a portfolio analysis as well. So see you in the next video, which will be about derivatives. Till that time, bye and have a good time. Thank you.